Before you start, right? Cool. Good afternoon, ladies and gentlemen. Thank you all for attending our second quarterly update for the year. We've got a lot to unpack here, but before we dive in, just a few housekeeping rules to make sure everybody's on the same page, and a few bits for compliance here. This webinar is being recorded, and a recording will be made available afterwards on our YouTube channel, as well as a follow-up, so you'll be able to dive in through the material at your own pace. With that being said, information presented here is for educational purposes only and does not intend to make or solicit any offer for any investment strategies or products discussed herein. Please be sure to first consult with a qualified financial advisor or tax specialist. With the disclaimers out of the way, just to give the format here, we have a number of items that we'll be going through. We will have a dedicated Q&A section towards the end, so please save your questions then. Otherwise, feel free to use the chat function to type your questions, and if they're relevant to the topic at hand, we'll pick those out and pick those apart actually as we go through this presentation. But with that said, we've got quite the agenda here. So if we dive right in, and why don't we unpack what's actually going on here? And with that, I'm gonna throw it onto the next screen, and if we address sort of the elephant in the room here, which I think for several of our subsequent updates as well has been inflation. So before we dive into what we're looking at here, and Brian, maybe I can get your thoughts here. Inflation has taken a remarkable turn, compared to where we were a couple months or even last year. So the question I have to you is, first of all, what are we looking at here, and what does this mean for the consumer?
Well, inflation rates over the long haul should average closer to 4% or 3%, depending on whether you leave the 70s in there or not. Naturally, what we're nervous about is that we have a retracement of what it looked like in the 1970s. And if you go all the way to the beginning of that chart, you can see that there was a spike up in inflation, it dropped back down, and then it spiked all the way back up. So that's what we're nervous about when we look at the more near-term cycle. The placement of this is that essentially inflation has come right back down to where we want it. It's close to those levels to where the Federal Reserve is talking about decreasing interest rates, potentially even really soon. That's where we had a nice rally in the market the other day. The problem being is that we have a presidential candidate, and that's going to be a topic that we're going to be talking about later, that has a potentially inflationary agenda. So we have to hope that that agenda is more of a talking point for him, and that he doesn't execute on all of those, because otherwise we could see a retracement to the 1970s. That's our biggest fear right now, is that if we affect things in some of the ways that that Donald Trump as a candidate would like to do, it has four main reasons that we articulated in our last newsletter, that those would be inflationary on the overall marketplace.
Mm-hmm. And just to interrupt there, Brian, on your train of thought, I know later on in this session we'll be discussing both Trump and Biden's different policies and its impact on the markets, alongside Josh, who'll be giving a deeper dive. But that's really interesting that you pointed out the echoes of sort of the 70s and 80s there. Aside from the political sphere, what else, in your opinion, can potentially lead to inflation having that second spike higher and having a repeat of the 80s, that could potentially lead to some sort of mismanagement when it comes to policy there?
Absolutely. The precursor of any growth in inflation right now seems to be trade wars. It's all about borders right now, and we still have problems in many of the biggest trading portions of the world. And potentially, if China were to try to invade Taiwan, that would mean that we'd have the full trifecta: environmental problems over in Panama, the Suez Canal basically being taken up with some problems from rebels, and then a potential conflict out there in the China Strait. So we need to remain focused on that. The consumer right now is being affected by high interest rates, and that will continue to be the case unless interest rates were to come down.
I think that leads
And
quite
that's
nicely onto the next slide there, actually, which is interest rates, actually. I think you know, the expectations are that the Federal Reserve this year will at least be cutting potentially once, and some estimates are that we might even get 2 rate cuts. But if we stick to the US for 1 minute before we dive into what's going on in the UK and Europe, what are some of the impetus, I guess, or the rationale there of the Federal Reserve to actually be cutting rates right now instead of just keeping them higher for longer and not having to repeat the same mistakes of the 70s and 80s?
Well, in simple form, we have a tale of two cities on the U.S. front. When it comes to corporations, and when it comes to the rich, or the upper middle class to the rich, they have had a positive effect by increased interest rates. If we think about the retired individuals in the United States, having fixed income that earns them 5% on an annual basis has been positive towards their portfolios. And the overall stock market has had a wonderful year. Now, when it comes to the lower middle class and the lower class in the United States, they have struggled this year. We have seen delinquencies on cars, credit cards, and everything in between increase significantly. And those consumers are having a lot of hardship. So decreases in interest rates will hopefully reverberate and alleviate some of that pain that they've been feeling. And naturally, the Federal Reserve has to balance that. They need to try to mitigate a lot of that inflation. That's their primary concern. But at the same time, they would like to avoid that recession, that hard landing in any way, shape, or form. The numbers are starting to come out to show and indicate that they have. So that's to your point, Cam, we might see a couple rate cuts this year. We have to remember the majority of the street thought that we were going to get upwards of 6 or 7 rate cuts this year because we got 7 rate increases in the year prior. We are not getting 7 rate cuts this year. It's ticked down each and every month. And there's a good chance that essentially we could go through the end of the year without getting those rate cuts. The activity the last couple of days on the stock market is in anticipation that it could come sooner. But we have to remember that essentially the Federal Reserve doesn't want to have fingers pointed at them for affecting elections. And so we could see them potentially putting this off until 2025 in certain regards. But as you can see, the direction of this dot plot, which basically from left to right shows each year what the different members of the Federal Reserve anticipate interest rates to be at. Essentially, the longer run is that interest rates are expected to go down and not up. So the Fed is quite positive that inflation is going to be taken care of, whether it be already, but definitely in the future. So that's an optimistic tone when that's one of the biggest costs for most corporations and most individuals.
I think the real impetus there is you know, the Federal Reserve, as with some of the other central bankers, they're being quite flexible in their approach, right? Whereas instead of being particularly married to one direction of travel, I think they're waiting quite appropriately for the data to actually come in and support their rationale for those rate cuts, as you mentioned. And not wanting to, be too aggressive in their rate cuts and then, have to battle inflation all over again, I suppose.
Absolutely. And we have to also remember that most countries don't want to fight the Federal Reserve. The Federal Reserve is much bigger than most every other currency combined.
Mm-hmm.
And that's where we've had some surprises in Sweden and Canada decreasing rates ahead of the Federal Reserve. But when it came to the three big guns, the ECB, the Bank of England, and the Fed, they're a little bit in line. Now, we had a little bit of a surprise this morning that we had a little bit higher inflation than expected. So we might have to wait a little longer for the Bank of England to really move things further down. And at the same time, the US might be moving a little bit faster. That's why we've seen some big movements in currencies. But you can see from these charts that all three of them are expecting to decrease in tandem. The anomaly being the Bank of Japan. We'll keep that out of the conversation at this point in time because that's more of a speculative trade that is 30 years in the making, and Warren Buffett has gotten bigger in the news than the potential success of that.
Mm-hmm. So I guess if we move along from interest rates and what the central bankers are potentially up to and will be potentially up to in the foreseeable future, if we take a step back and just look at the U.S. equity markets in isolation, so we'll look at the international markets for the audience later on, but if we just hone in into the U.S. markets specifically, as you mentioned, Brian, we've had a spectacular run up in the overall market, and valuations have gone up, and we've hit multiple all-time highs on the market as well. But with that said, the question that always comes to many investors' minds and such is, are we overvalued?
It's always the age-old question of whether we're overvalued or undervalued, and the honest truth is, it doesn't matter if we're overvalued. That just means if something happens, we've got further to fall. We're only one standard deviation away from the 30-year average Shiller PE ratio, which means we'd have a little bit further to fall if we had to fall. But with falling interest rates, that could put us right in line. On top of that, the components of the index are driving real earnings, and that's to where what we really need to focus on is what is the S&P really made up of? And the main thing are the Magnificent Seven, or in this description, the top 10 stocks that are mostly all technology stocks, have ever increasing earnings. So their earnings are substantiating the growth that we'd expect. So you can see the top 10 stocks in the S&P 500 have a 20.4 Shiller PE ratio. The S&P 500 is at 16.6. If we just take out those top 10, so the S&P 490 is at 15.7. So the S&P 500, the 490 of them are undervalued compared to their long-term averages. Whereas essentially those top 10 that are growing their earnings significantly are quite expensive. So you're paying for that quality. Mm-hmm. As long as we expect that to continue, and there's no reason in sight that the likes of Microsoft or Google should have large drops in earnings, essentially the market can substantiate these higher prices. So we're not worried in that way, in any way, shape, or form, that these valuations show as a little higher, as long as we don't have those jolts in the market.
Mm-hmm. And I think that's a really good point there, because when we look at valuations, everybody gets so fixated on the price and how expensive something is, but they forget the E part of the equation, right? So when we look at PE ratios, it's price to earnings. And I think, as you mentioned there, Brian, the earnings component there is very, very pivotal. And I think in the coming earnings seasons, if the Magnificent Seven or the top 10 largest companies in the index, if they can continue to deliver those earnings growth going forward, then something that is potentially expensive now, there's no reason why it can't get continue to get more expensive. And I think the the best example of that is Nvidia. You know, people thought it was expensive a couple of months back, and you know, the earnings growth has continued to surprise to the upside.
Absolutely. I mean, looking at the chart in the upper right, if you look at that first quarter 2024, the Magnificent Seven, their earnings growth was 50%. That's magnificent, you know, hence their name. The other 493, a drop of 2% year over year. So it is truly the tale of two cities. We need to remember that. And anything that has AI in it, people are paying galore for those investments. So essentially, as long as this is the case, the S&P 500 will be fine in that way. There are going to be winners and losers in different ways, and so we need to focus on that. We have to remember that essentially the tech sector will keep on growing as long as people are focused on that AI, but the financials, potentially even real estate, they're going to be driven mostly on what the debt ratios are, and if interest rates are coming down, that will help them. That will help them grow their earnings. That will help them refinance it in better ways. So we need to focus on how we've constructed our portfolios and which ways, who's going to benefit from not just what's on the front page of the news, but essentially those lower interest rates.
Right. I think that's expertly, you know, portrayed in this chart here, which really showcases, as you mentioned there, Brian, with interest rates potentially coming down in the US, the sectors in the market that are most sensitive to those rate hikes or rate decreases are really the small cap sector, right? And as you can see here in this chart, what we're looking at is a lot of the debt that's coming due, or percentage of the debt, I should say, that's coming due for the S&P 500 versus the Russell 2000. Naturally, the S&P 500, 500 largest companies, whereas the Russell 2000, that's more of your smaller cap focused index there. And, you know, as you can see, a lot of that debt refinancing wave is coming up, you know, in the next few years. And you know, if interest rates, as you were mentioning, Brian, if they come down, that's going to be a nice sort of tailwind, you know, for these smaller companies, especially when it comes to rolling that debt. And you know, potentially, if we don't get that, then I think you know, that particular sector could run into some trouble. What are your thoughts there?
Absolutely. That first little speed bump was this summer. We had a lot of debt coming due here in July. We saw a lot less bankruptcies than were expected. And now all of a sudden, what are we getting news of? Well, Goldman Sachs, Morgan Stanley, they're announcing that the M&A process has restarted after a couple years of lull. And a lot of that is basically because of the debt cycle coming due. Some of these companies need the extra cash flow, and it's better to sell themselves than just to go ahead and reestablish new debt. But like you said, Cam, if by 2026 and 2027 interest rates come down, they'll have a much easier time at refinancing that debt and keeping their costs low.
Okay, let's I guess switch gears for a minute here and just keep track of time here to make sure we have plenty of time for our Q&A. The other part that we mentioned on or touched upon briefly, I should say, is real estate. Now we'll discuss essentially what we've done as a firm when it comes to our approach to real estate, but it's had a tremendous roller coaster of a ride, the sector as a whole, both in the US and globally. So before we dive into what we're looking at here, why don't we just give sort of a real brief state of the union of why real estate has been such a drag in the mud, Brian?
Well, we had 40 years of great real estate growth on the backs of interest rates going down since 1982. If we think that valuations are expensive on the S&P 500, real estate evaluations got really expensive a couple years ago, and then COVID came about. And COVID changed a lot of people's behavior. And with their behavior of not going into the office anymore, one whole slug, one segment of the real estate market became unattractive because the question came about of whether the office was still going to be a place that people would go to. Pre-COVID, we've got to remember, I think it was about 10% of the world's service segment worked from home. During COVID, it got to 50 to 60%, depending on which reports you look at. Now, the best report of where we're heading towards is that it should be around 20%. And the justification behind 20% is that that's about the percentage of people that want to work from home. So it will take some time because certain people will have to quit a job to go find another job just so that they can work from home. And other people will get hired into organizations that do require them to go to work. But there will be that evolution to 20% versus 10%. But that's a lot of office space that's going to come offline. Now, that's just one small slice of the real estate investment trust industry for REITs. We've got to remember there's certain segments that are just getting bought up left and right and still have decent valuations. Server farms, any logistics centers for distribution centers. We have a big IPO coming out this next week when it comes to cold storage on the US side. I think it's rumored to be coming out at 29 billion. So these are not small companies, and they have absolutely no problem with rentals or people not showing up to work because you can't keep freezers or server farms at home. These are things that need to be in commercial areas and need to be in collectively good areas. So what we're looking at is the fact that a couple bad years and one big pandemic might end decreasing interest rates instead of increasing interest rates might bring about the opportunity to start building positions back into real estate. Not all pieces of real estate. There's a lot of pieces that will have the same problems as small caps. So we need to be careful with that. But we should be looking at getting back into some good quality.
Absolutely. And I think if we skip, just for the sake of time, if we skip 2 slides ahead, or yeah, 2 slides ahead, one more, there we go. And then that will actually showcase the point you were mentioning there on the next slide, Brian.
Apologies.
There we go. So this is actually a perfect representation of the same sort of analysis with small caps, where again, real estate as a sector is very debt sensitive. And just last year, 2023, when we look at sort of the debt maturity as a percentage of the balance sheet for a lot of these REITs, a lot of these individual real estate projects, it was closer to 30%. So between last year and this year, a lot of pain has already worked its way through the system, both globally and in the US as an isolation. And in the coming years, that percentage of debt that's coming due and having to be refinanced is gradually shrinking, right? And potentially with interest rate cuts on the horizon, again, that's going to be positive for that sector as a whole, as you were alluding to there, Brian.
Absolutely.
And I think this slide here really just sums up why we want to have real estate, I suppose. When it comes to portfolio construction, I guess, there's several key aspects that go into building a well-diversified portfolio. And one of them is having, diversification as a whole. So maybe I guess the question to you here, Brian, is with the bond part of our portfolio, as you mentioned, finally providing some decent interest rate there on the short term and potentially some upside on the longer end of the curve. Where does real estate really fit into portfolio construction on a longer term basis?
Absolutely. It's definitely an alternative asset. And in my mind, right now, with interest rates going down, which basically means the value of your real estate, your fixed income would go up if interest rates go down. Essentially we have a nice little barbell strategy that if the stock market does well, the fixed income market might not do so well. But if the fixed income market does really well, the stock market might not. So all of a sudden, one does well and the other might not do as well. Now, real estate can play a place in between because real estate will do really well if interest rates go down significantly. From Cam's chart that shows how much debt they hold, that will decrease their costs in different ways. But it's also an inflation hedge just in case we get the inflation part wrong. And as we were alluding to earlier, we are afraid, our biggest fear right now is that we fall back into the 1970s. The 1970s having excess inflation after it was curbed for a short period of time. So we want to make sure that it can sit there and hedge that part of the portfolio, and it can get closer to equity-like returns with fixed income-like income in between. So it sits as an alternative in our collective of investments.
I guess if we move on to the next slide here before we really address the elephant in the room, which is the political shenanigans going on, but we'll leave that to Josh and yourself to dissect. But just as a summary, you know, as I was mentioning earlier on in this sort of webcast here, we've made several all-time highs just this year alone, and you know, going forward, I guess the question on everyone's mind is, you know, when is it a good time to actually start investing? And actually, are all-time highs even a good time to be dipping your toes into the market?
Absolutely. The best time to invest, it was always 20 years ago. You know, the second best time is now. And the simple reason why is that we're always going to be hitting all-time highs. If it isn't these companies in the S&P 500, it will be new ones that are created, the small caps coming up to be the large caps, and they'll shift around to be greater and bigger than what they currently are. But essentially, 85% of returns come from having the correct asset allocation instead of timing the market in any way, shape, or form. So don't worry about timing the market. Just get invested for the long term and get going.
Perfect. That's a nice summary there. And I think then, why don't we just sort of wrap this up here and sort of land the plane over. We've discussed some of these key economic aspects and monetary aspects, but what does this actually mean? So with that, I guess we'll hand it to Josh to give us a brief dissection of the political landscape in the US and potentially a back and forth conversation of how this impacts the market.
Absolutely. So thank you for that, Cam. You say shenanigans. I was thinking more hijinks is maybe a more fun word we can use, I guess, to kind of bring the mood up on this a little bit, because what you've been hearing from me in particular for this year so far is that this is the year of global elections. And well, we're more than halfway through the year. We've seen a lot of them already. And there's been 35 elections so far in the major sort of democratic nations in the world. More than 2.3 million ballots have been counted. There's basically been more voters than ever who will have voted at the end of this year in at least 64 countries, plus the EU. So it's been a very momentous year in those types of ways. And maybe in some sort of dramatic fashion, we're going to end it with the one in the United States, maybe the most consequential, well, definitely the most consequential sort of economy in the whole equation. We did start the year with, for example, just to give everybody a brief refresher, Taiwan's pro-independence party victory in January. We went on to see very predictable results in places like Russia. Slightly surprising in India, as Modi didn't win by as strongly as many thought he would. And more recently in France, the left-wing coalition coming out on top. Now, with a few left to go, obviously, the elephant in the room is the United States. You guys thought you could get away from talking about it in this webinar. Well, not this one. So it's going to be everywhere for a couple of months. Now, talking about where things stand in there, not to get too deep in the weeds on this particular aspect, Well, the polls continue to favor the Republican candidate and Trump, and there's um, a lot of big recent news where we've had to kind of rewrite some of my notes on this, given how events have been overtaking. But basically, what remains the same is that it seems likelier at this point in time that we'll see that come to pass. Now, recent events haven't really given him a huge boon, so there's still the same sort of polarization that you'd come to expect. On the other side of the equation, for now, as of this time, President Biden still seems likely to be running again. But essentially, we probably know all that already. So, what does all of that mean? So, for that, I would go over to the next slide, just talk about what we could expect from those different aspects. Now, some of this is probably pretty straightforward, but essentially, right now, the most likely outcome is that the GOP sweeps at a 45% chance, as you can see on here. Now, that being the case, that wouldn't look great for Chinese exports and imports, obviously, because well,
so Josh,
Yeah.
sorry, let's back up for just 1 second.
Sure.
By sweep, we've talked about the Republicans potentially winning the White House. But
and that right, correct. So
what do you mean by sweep?
So I mean they get out a broom. No, I'm just kidding. So they would have control of the White House and the House of Representatives and the Senate in this case. So that's what that would mean. Wouldn't be good news for Chinese exports or imports. Well, Trump has been traditionally pretty vocal about his opposition to those types of aspects. One of the aspects that Biden and his team have been well known for is the grid technology with green energy and such. Not so much with the conservatives who tend to favor the use of fossil fuels. So we'd expect those different aspects to trend in a more bearish direction for electrics. Fossil fuels would be something people would be more bullish on if this sweep were to happen. And aside from that, Medicaid providers, I don't know if you have any thoughts on that, Brian. I was a bit surprised, to be honest, to see very bearish on the GOP sweep. Do you have any thoughts on why that might be?
Absolutely. When it comes to Medicaid providers, it's not to say that essentially they're going to close them down and not give them their benefits. The Republicans will probably just cut their abilities of being as profitable as they might be. So it means that we want to shy away from those types of areas because they'll come in and they'll say, this is the total cost that you'll receive at the end of the day. Now, in my mind, how we're looking at the portfolio overall, when we're talking about a potential sweep and it's 45%, we're not going to make a gamble on saying, hey, the Republicans are going to get one side, or there's a 10% chance that the Democrats are going to get a sweep. I'm mostly concentrating on those areas that are bullish across the board, whether we have a Republican or a Democratic president, and whether we have a Republican or a Democratic Congress and Senate. So you can see those most important areas are near the bottom. Semiconductors, let's call it infrastructure with road and bridge repair, and aerospace and defense. Now, the spending in aerospace and defense has been astronomical. I can't remember, I think it's 18 of the NATO members have now gotten up to 2%. And essentially, that means that the number of orders has significantly increased. For some reason, aerospace and defense stocks have not performed as well as the S&P 500. I don't think that's going to change because we have a few names in there that are having a lot of trouble. And some other powers that be are essentially questioning whether the government contracts are accretive towards companies doing well by the government, but also being profitable for themselves. So we haven't been investing over there, but the amount of spending that will go to that area will continue to increase. We'll continue to evaluate that segment. I don't see changing my position unless they change their ways. That being said, when it comes to the semiconductor build-out, we have talked significantly about the push on the grid. That is where the spending is coming from. And it doesn't matter which side wins. That's going to continue to be the case because we need it across America. The amount of energy use has been significant, and those semiconductors are essentially the main benefactors there. So I really want to concentrate in those types of areas, and I really want to avoid areas like electric cars where it's either very bullish or very bearish. Then we would be taking a concerted effort into a place. I don't want to sit there and worry about things too much in those types of ways, because this is going to be a little bit of a flip in the election, as we saw in the last slide. It's being based on 7 states. So don't count on Florida. Well, this time it's not Florida, but don't count on one state saving the election for you. And that's why we want to be looking at what segments potentially going to do well.
I think it's been a while since Florida's been one of the true swing states, though, hasn't it?
Well, last election was still significant, but I don't think COVID was good for their demographics, with more right-wing leaning people moving down from the Northeast to Florida and swinging it further towards the right.
Perfect. Well, then I believe I'll hand that back to Cam to wrap this up with the themes relating to the updates to portfolios.
Perfect. And I think it's a really nice summary there of some of the changes our clients can look to expect in the portfolios in the coming months and quarters. So we've discussed sort of the framework and presented you with some of the key facts and information, that's leading to some of this decision making behind the scenes. So, as we discussed, you'll start to see a slight uptick in that small cap. And really, we've seen it play out in the last couple of days, but we'll have to continue to see that data come through positively. The other part, which I think we've discussed many a times, both on our last update and the previous ones, is sticking to the longer end of the curve there when it comes to duration. Now, there's a bit of a caveat there when it comes to continuing to maintain that position, especially if the deficit in the US and some of those tax cuts that I think Josh and Brian were discussing from the Republican side do see the light of day. Potentially we might get a bit of a uneasiness in the bond market, but again, that's something we'll have to cross the bridge when we get there. And the other aspect, as we touched upon, was real estate. So a potential reintroduction of real estate into the portfolios, especially as interest rates start to come down. I guess with that said, we'll hand it off to my colleague Isa, for a few planning items and a message on her side.
Hi, everyone. We're going to talk about how to obtain your Social Security statement today. So you may know that the traditional way of getting your Social Security statement is reaching out to the Social Security Administration that is responsible for the country in which you reside. But there's also another way, and an actually easier way, to get your information by logging into the website My Social Security. Now, in the past, it was not possible to register for this website if you had a non-US address. So in other words, if you are a US expat living abroad and you have no US address whatsoever, it was not possible to register for My Social Security. That has now changed since the Social Security Administration has partnered up with an app called ID.me, which is a digital identity wallet that was originally established by US veterans for the purpose of military administration. Now, a lot of governmental websites started using that app as well, which makes it easier, especially if you are living abroad, to access various websites, such as the Social Security website or the IRS website. Now, logging in or registering for ID.me is relatively simple, secure, and it's free. So I want to encourage that you try registering there so that you can get access to my Social Security, and you have all your benefits information, earnings history, tax documents if you already receive your Social Security right at your fingertips. Now, the reason why we encourage you to do that, and please, if you get your Social Security statement, make sure to share it with us, is simply because we want to make sure that your financial plan is up to date at all times, and that we have all the accurate information so that we can estimate your retirement cash flow, and your retirement income, such as Social Security, of course, makes an important part of that. Another important aspect why we want to look at that is because we want to have a look at what age does it make most sense for you to actually start receiving your Social Security benefits. For some, it may be at 62, for others at 70. For most of you, probably the middle for full retirement age, either 67 or 68. So yeah, that's something that we want to look at. And we also especially want to review, are there any certain benefits that you get if you're married or if you have been married in the past? So yeah, make sure that if you have your Social Security benefit statement, that you share that with us, and we can work with that and implement and update your plan. Thank you.
Okay. That's the message from Isa about planning. If there are any questions, again, please do get in touch. And with that said, we're right on time for our Q&A. Before we dive into our Q&A, actually, we've got a little plug-in for our next webinar for DF Direct. So why don't we head over to the next slide there really quickly, and hopefully Ruben can give us a brief introduction of what's happening in the next couple of weeks.
Sure, thank you for that, Cam. So, hi everyone, I'm Ruben, and I look after our newly launched product, DF Direct. It's an investment platform exclusively for Americans, which offers solutions in a low cost and compliant manner. We have 6 funds on DF Direct, ranging from conservative right through to aggressive growth, which means it's suitable for any clients and their investment journey. It's fitting for clients that don't currently need full financial planning and would like to lower their fees. It costs less than half the price of our full financial planning service, and we can seamlessly transition you between full DF Direct or financial planning services. So yeah, I'm here to help. You can reach out to me via email on ruben@dfdirect.com. I'd be more than happy to chat through the product or get on a call or a Zoom to walk through setting up an account. And as it says there, we're hosting a webinar, which is an introduction to DF Direct, a bit of an overview of the product, as well as what it has to offer you. So that is in 2 weeks' time, 31st of July at 2:30 p.m. BST. So look forward to seeing you there, and feel free to join up and jump into that webinar as well. Thank you.
Brilliant. Thank you, Ruben. Cam, thank you for hosting as always. Josh, wonderful insights on the U.S. elections and well, all of the 60 some odd elections around the world. If any of you have any questions following this webinar, please reach out to us individually or collectively. And from there, we hope you have a wonderful day.
Perfect. Thanks so much, guys.
Thank you.